You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
We'll take out that 1923 previous high, and I'm looking for gold prices 2.5, 3.5 over the next 3 to 4 years, and I think that looks pretty solid.
I'm Bill Powers, and this is Mining Stock Education. Thank you for tuning in. I'm speaking with Barry Dawes of Martin Place Securities. He has extensive experience in corporate financing within the mining sector, having done over 30 IPOs, raised over $1 billion Aussie over his career. He is a high-profile market commentator in Australia as well. He writes a newsletter called Dawes Points. He's formerly trained as a geologist. He's been a researcher and analyst for large banks, and he also is a broker. So Barry, who joins me today, has a multi-decade experience in all aspects of the mining sector. So I invited him on the show today to share his perspective of what's going on in gold, in mining, and in particular educating the North American segment of my listenership so we could be up to speed about some of the key things that are occurring in the Australian mining sector. So with that introduction, Barry, thank you for coming on Mining Stock Education today.
Well, thank you so much for the invitation, Bill. Look, I'd like to start off with just the gold price. Now, we all know that the gold price has been moving up, and what I tell my clients is that we've sort of broken out after a period of about 3 months consolidation in our first slide, and then if we look at our second slide, we can see that we're coming up to this $1,800 mark, which to me is quite significant. It might take a little while to get through it once we move up a bit higher. But once we get through that, the long term in slide 3 shows that we'll take out that 1923 previous high, and I'm looking for gold prices 2.5, 3.5 over the next 3 to 4 years. And I think that looks pretty solid. I've got a wonderful long-term graphic here from Jason Atkinson. People might follow him as Schism on Twitter. This long-term 100-year chart on gold looks really fantastic, and it suggests to me that it's going to go much higher. The rationale I have in gold is that we've got 185,000 tons of gold above ground, and about half of that is actually in jewelry, and about half of that is in India. By the time we take the Middle East and China, a lot of that gold is really tightly held and it's not going to come into the market. What we've also seen is China and India have absorbed a lot of gold from new mine production and from the West. So I like to think that the West has reduced its holding in gold for one way or another, and it's underweight. So there's a short position. Now we can worry about COMEX or whatever else, but at the end of the day, I think people are just underweight. And it was very interesting to see that last year in the United States, jewelry demand was the highest in about 10 years. And I think it might have been a record. So the US is buying gold, or North America is buying gold. And I like to think of gold as the metal of prosperity rather than the metal of crisis. That might not be very popular, but that's my view. So when we start looking at Australia, we've had the A-dollar, which has been soft against the US dollar, and consequently the A-dollar gold prices at a record level. Now we've got gold prices at record levels, I think, in almost every currency except the US dollar and maybe a couple of the Middle Eastern currencies. But in A-dollars, it's been good, and it's around 2,500 A-dollars, and that has been very, very good for the Australian mining industry. Now, the Australian gold stocks really bottomed in June of 2013, well before the North American indices and the gold price. Our gold index actually bottomed at the end of 2014. So the Australian gold stocks, the Northern Stars and the Evolutions and the Regis and the Saracens, these things have actually been leading the world in this global reflation that I call, and the tying in with the demand for gold. Now, in Australia, we're the second largest gold producer. My slide 6 shows gold production going right back to 1850. You had your Californian gold rushes in the late 1840s. Australia had its really starting in New South Wales, but quickly overtaken by Victoria. And it wasn't until Western Australia and Kalgoorlie came in the late 1890s that we saw gold production surge. But by about 1920, our gold industry was pretty well dormant. And then with the gold price rising in 79, 80, we got a big response, very strong move in our gold production to take us up to nearly 350 tons annualized. And I think over the next few years, we'll get pretty close to 400 tons. And if China production declines, as I think it will, Australia should become the #1 producer. Now, for those people who know Australia and those people who don't, Australia's down under. We've got some big states, and we've got 6 states. Most of our gold production comes from Western Australia, but historically Victoria was very, very important. New South Wales is becoming more important, but all the Northern Territory, South Australia, Queensland have their gold industries, and these sort of tend to wax and wane a bit. We've also got a little bit down in Tasmania, but there's some real excitement going on, and people should understand where the Pilbara is. Now, those people in Canada will know about Novo Resources, and this is an extraordinary discovery of these Pilbara conglomerates and the alluvials that have come from that. Novo's done a fabulous job up there. And we've got something else which is very, very important in the Pilbara, the Melina Gold Project, which is a major gold discovery, which will be in excess of 10 million ounces as we go through the next few years. But the Pilbara is best known for iron ore and some other minerals like that, and it's had very, very little gold. But over the last 3 or 4 years, we've seen a real expansion in it. The driver, though, is the Yilgarn. The Yilgarn's an old cratonic area with Kalgoorlie that you've probably all heard of as the centre of that. And Western Australia produces about 65% of Australia's gold. The other thing that you really want to be knowing about, and those people in Kirkland Lake and Fosterville South and so on would know a bit about Fosterville and Bendigo. The Bendigo zone in Victoria produced 60 million ounces between 1850 and about 1920. And it's been essentially dormant ever since, but there's a real renaissance that's underway there. And that's it's becoming very, very exciting. You're probably aware with Fosterville, Kirkland Lake produced 192,000 ounces at 49 grams back in December quarter of last year. That's probably going to be the peak in terms of grade, but it's going to be producing 600,000 ounces at well over 30 grams and a very, very low cost producer. So there's lots happening in Australia. So if we look at our slide number 8, this is our mine production on a quarterly basis from our Bureau of Industry. Australia, as I said, it sort of did 346,000 tonnes in December, and it's on its way up towards 350. Western Australia, as I said, produces about 65% of Australian gold production, and that's rising as well. But we're finding that Victoria and New South Wales are actually coming up and taking sort of market share from Western Australia. The other really important thing is that we have a very, very active exploration industry in Australia, and some of our our best companies are in the gold sector and gold exploration. There's a lot of technology involved. There's a lot of intellectual thought, and over the past 2 decades, and the last 10 years in particular, there's been a real revolution in understanding the geology of Australia. As you would know, Australia is an old continent, which means it has a lot of oxidized rock and cover over bedrock. And consequently, we've had to develop our remote sensing skills to a very, very high degree. So exploration in Australia is still running over $1 billion annualized, and a lot of money's been raised by these companies over the last month or so as we get a bit of excitement. And so I can see the exploration numbers going forward being much higher. Historically, we get about $50 an ounce finding costs. So if we're spending $1 billion, you can expect us to come up with about 20 million ounces a year in new resource. And if we say 50% of that will go from an inferred status to an indicated status and become mining reserves, we're actually adding to our total overall inventory of gold resources, because we're producing at about 11 million ounces a year. Now, the other thing that's really interesting, if you look at slide 10, we've got a new generation of deeper drilling, and the results over the last 6 months have really been quite spectacular. What this graphic from evolution of a couple of years ago was basically showing that most of our drilling was down to 50 meters, 150 feet. But by the time you look at the drilling that's been done right throughout the country, and this just one little part west of Kalgoorlie, very, very little drilling has gone down below 200 meters. So we're finding a lot of really interesting stuff, and a lot of the grades that are coming through as we go deeper are much, much higher. So that, I think, is very, very exciting. Now, what I'd like to talk about is one, Victoria. If you look at our slide 11, this is the action in Victoria. Now, the Bendigo zone produced 60 million ounces, but historically, and you can see there, Fosterville, 4 million ounces, not very far away. But everything to the north of that brown line is got quite deep cover of 15 to 20 meters of cover, so it's all blind. But do note the size of the tenements. They're very, very large. Those south of the cover are more interesting, and we're finding out a lot about the Victorian goldfields. For example, there's a place called Tarnagulla, and there's one thing called the Poverty Reef, produced 330,000 ounces at 6 ounces a tonne. So there's a lot of excitement there. The other area which is of great interest at the moment is the Malina Gold Project in the Pilbara. And I think we're going to see something that's going to be well over 10 million ounces here. And there's one company that owns 100% of most of the area. Now, all this is being shown up in the Australian share market with our gold index. Our gold index going back to 2000. We didn't have we didn't have this gold index before 2000. But you can see that we're back up at that sort of 8,000 to 8,500 level. And when we break through this, I just see a very, very large inverted head and shoulders reversal pattern. Once we break through 8,500, I think we're going to see some very, very big numbers over the next 3 or 4 years. So I think it's a pretty exciting area here in Australia. There's some names that you will probably know, the Newcrests and the Northern Stars, and Evolutions and Saracens, Regis. But keep watching some of the others that are coming up. De Grey's Mining, Kalamazoo, have a look at a thing called Musgrave and Chalice. And these things are very, very exciting stories.
Barry, what do you think about Vista Gold Corp there in the Northern Territories? That's been a legacy project which Vista, a Canadian and U.S. company, has advanced. What is the perspective of your perspective as an Australian mining analyst?
That's Mount Todd, isn't it?
Yes, Mount Todd.
Yeah, look, it's very interesting because I think it's the biggest or second biggest undeveloped or non-operating resource in Australia. Doesn't get a lot of following because it's not part of our listed group here. Commentary is it's very, very hard rock, and that really means that it becomes expensive to mine and process. However, in the gold market, price covers everything, and if you've got $2,500, $3,000 you can still make money. It'll be a very highly leveraged play for those people in it. I don't follow it, so I can't say anything more other than what I've said. I think people who know the company would be better placed than me, but it is quite different to what we've got, and I think it's been there as a large deposit because it's been difficult to mine and process.
How would you explain the share structure differences that we observe in the companies that list in Toronto versus in Australia? With it's common to have an explorer developer with over 1 billion shares, whereas in Toronto we would consider that share structure overblown. What is the difference in perspective between these two areas of the world?
Oh, look, I think we've always thought of it in terms of market cap rather than the number of shares on issue. And I subscribe to that. I mean, it doesn't matter how many shares on issue. If you've got 1 million shares or 10,000 shares and the value is the same, well, it doesn't matter. There might not be any more shareholders.
But you have to pay attention to how tight the float is, though. Would you agree with that point?
Oh, yeah, I agree with that. But if you've got the same number of shareholders and the same market cap, but one's got 10 times or 20 times as many shares, I don't think it matters. But what I've found in the Australian market is that people do like the liquidity that you can get with stocks that have a lot of shares on issue. But that also means that people can pick up a 1 or 2 or 3 or 5% holding in the company relatively easily when the stock's sort of in a normal trading pattern. But that has the effect of tightening it up, and once that happens, the stock just performs like anything else. It's all about market cap. It's interesting that we've got a company that people in North America might be seeing a bit more of, a thing called White Rock Minerals. It's got some assets in Alaska, and it's got this last chance deposit, which Quentin Hinnig, whom many of you people would know, thinks it's got the best geochems anomaly that he's seen, and it's very, very similar to that discovered by Pogo. Now, that company had a few billion shares. It's had 100 for 1. Will have a 100 to 1 consolidation in the coming month, and but that stock's gone from 0.3 to 1 cent, so it'll be the equivalent of going from 30 cents to $1. So it's moving in terms of market cap, and there's been good liquidity and good market volume for people to trade that stock if they want. I think we're going to see a lot of consolidations But it's just the nature of the Australian market. We start with a 20-cent share, and because of the misery of the past decade, many of the stocks have had to issue shares at ever lower prices just to raise capital. I know that many people start out with the idea of keeping the share structure very, very tight, but it's very, very hard. One company which has done a great job in doing that is a company called Catalyst Metals, which is in Victoria, and that's done very, very well for our clients. It's still only got about 85 million shares on issue, I think. Trades at just under $3 a share. I think they've done a very, very good job there handling their capital structure, but they've been very, very fortunate in being the prime mover, or one of the prime movers in Victoria, and they were there before Kirkland Lake. So, yeah, it's an issue, but it shouldn't be an issue for anyone at the end of the day if they're thinking just in terms of the market cap of the stock and the percentage ownership of the stock.
Thank you for that answer. Barry, before you go, other than gold, which you're very bullish on, what commodity as a mining investor would you point out that we should be paying attention to?
Well, look, I do like the concept of electric vehicles, and a lot of that depends on lithium batteries and the lithium battery price coming down to make them competitive against internal combustion engine vehicles. But I think sort of once they are truly economically competitive, and I don't know where they're going to get the electricity from, but I think they will become very, very important. And so you come back to lithium, and lithium comes from brines, and there's a very small amount of that which is essentially in South America and a little bit in the US and a bit in China. The rest comes from lithium from spodumene and pegmatites. A bit higher cost structure, but Australia is the leader in production there. I think lithium, the demand for it is going to rise 5 or 6 times over the next 5 to 6 years in a relatively short period of time. I think it's one that will have good demand in terms of volume and a good improvement in price. But I like copper, and I like nickel, and I like iron ore. I think steel. If we get through the next year or so of the convulsions the world's going through, there's going to be a lot more infrastructure. Steel will be very, very good. China's steel production's maintained a very, very high level, and international trade at iron ore is still pretty tight. So I think iron ore is going to be a really good place to be, and of course uranium. So, but I think there's a lot to like about commodities. They've been out of favor for such a long time. Their replacement costs, discovery costs, capacity utilization rates, inventory levels, all these are low relative to where they should be, and I think it basically is saying to me we're going to see a pretty impressive performance of commodities over the next decade.
Excellent. I agree with that thesis. You can follow Barry on Twitter at Dawes Points, and also in the description under Barry's profile, you can find his email address if you would like to reach out to him. His website also is mpsecurities.com.au, and the PowerPoint that Barry referenced in our discussion here, I will put a link to that in the show notes if you're listening in audio format only, so you can click on that and see the visual graphics that Barry was referring to throughout this conversation. It was a huge time difference. Thank you for staying up a little later for me, Barry, and thank you for coming on Mining Stock Education today to share your insights.
Thank you very much indeed, Bill. I appreciate the opportunity, and all the best to your listeners and viewers, and buy gold and gold stocks.